Hello, everyone. Welcome back. Fun Friday again with the Trend Following Trading Club on Twitter Spaces. No birds today. Don't be alarmed. There no problem with the birds. I left them at home on my travels for the Labor Day weekend in up to New York, and but I do have the dogs, and they have been fed, but they have been loud this morning. So hopefully they will behave. I've had a good week here. I don't know about today. I haven't checked. I'm superstitious on checking the markets too often and my performance. And but I'm pretty sure it was a much better month than last month. I'm on quite a little losing streak here. So hopefully August was what broke that losing streak for me. But still, it's good to see those trends holding in and loose pants paying off. I'm probably short like 30, 40 interest rate markets, and I got bounced out of a little piece of one of them on the big rally up. Um, Same with the currencies, 30, 40 shorts, long peso. Um, Absolutely did not get bounced out of any of those. So, anyways, it's been a good trend following period and kind of continues. Nothing. It's much better than we could ever expect, in my opinion. All this money, all these trends, not too bad of a give back, especially for I anticipate bigger give backs given the long term nature. It's seemingly I never get out of anything until it gives back a lot of the profit, but then it goes back and makes new highs like natural gas. So, anyways, okay, so we had some good tweets this week and good topics of discussion. Particularly interested in, I want to get back into this topic that came up on Twitter a few weeks ago from Absolute, which is this idea of unlimited profit in the shorts. So I think someone brought that up. Oh, Alp, and we can talk about that. And so I like that idea, along with a lot of other things, I'm sure. So I'll let Oleg kick us off. Are you ready to talk, Oleg? I'm going to say some words.
Oh, yeah. Yes, hello, everyone. I think, you know what I will say now, and I will say that I'm very happy to be here, because I was waiting all week, this discussion, that I'm in a beautiful place near the sea, on the Black Sea coast, and very hot here, and in the central Russia, and in North Russia, in St. Petersburg, it's cold. It's cold. And here in the south, near Sochi, it's very near Georgia. It's very hot, plus 30 degrees by Celsius, maybe even more. So I had a good swim today. So I'm very happy, and I say it every time because it's really so. It's straight from the bottom of my heart. This words.
G'day everyone. G'day Jerry. Yes, this month's last month was a good month. I found that a lot of the pain that I suffered in the prior month was restored last month. And look, one of the joys that keeps on giving is the yen pairs. I don't know if many others are trading them, but I'm finding they're just continuing to trend. So very happy with that.
Yeah, I like those cross rates. I've added a lot of those over the past couple of years, a lot of euro crosses, crossing the euro with everything, the yen, and the major crosses. And I've been able to add a few of the crosses with China, but some of the trends got going and they're far gone. I'm kind of conservative. When I add a market, I sort of might add it mentally until it goes flat. So when I put it back on, it'll be a new, fresh entry. But yeah, those things have done well. I'll be adding more of those on my way to 300 markets, which is going to be a lot of currencies and a lot of interest rates, 50, 60 commodities, and 150 equities. So for me, though, I have maintained all of my short stock futures pretty much, except I think I got knocked out of the Nikkei, but also I have some short stock ETFs, country ETFs that don't have futures. Some that do, like Switzerland, which Americans cannot trade, so I just shorted the Swiss ETF. I maintained all of those, but my portfolio of single stocks, some of those companies have been in massive downtrends for a year or so, and then some of them have been nice uptrends. So I do have a pretty good balance of longs and shorts in the
And
stocks.
Jerry, getting up to 300, are you going to stay at 25 basis points per trade?
No, I mean, I'm going to, I get it down to probably 15, 18. And, as I keep adding markets, I keep adding them the same size. And so after a while, my max risk budget has gone from 5 to 6. And so then I'm like, okay, stop doing that. And at some point I say, okay, let's make a big cutback of 15% on all of our individual market risk budgets because we got to, we keep creeping up from sort of the optimal level of 5 risk units. And so I actually have been from 20, I went down to 18s. So I'm going to hold at 18 basis points for a while. So, one of the great things about this is that I just don't get hurt that often with individual markets just really being painful because they're not really that relevant. They have to go so far. I'm in a situation where, number one, I'm hunting for outliers, and I've turned it into a situation where that's all that really matters. So a big, huge sell-off in some of these commodities, it really hasn't meant too much. If every currency rallied and every interest rate market rallied, obviously I'd get hurt. But that's pretty much what it takes. It's a really interesting way of trading, and it's not anything I've done different. But when you add the markets and then you reduce the size of each market, you observe, and it's just kind of laughable because what used to upset me, crude's down $5. I'm like, okay, that's 20 basis points or 30 or something so small that, and it just gives you this power and confidence to stay in these trades and really be able to suffer these drawdowns because they're pretty painful when you trade 50 markets, but not so much. I'm at 220 or 30 now, but I don't really count the short indices because I only go short, and there's so few stock shorts that I sort of just don't count. I'm up to 220 or 30 or 40, something like that. But on the way to 300 legitimate, and I'm going to stop 150 stocks with an unbelievably great diversification, I think, in a lot of commodity-based companies. So I think I don't want to get in trouble by trading too many stocks when everything goes to one correlation, but I'm sure I'll be subject to that as well.
Jerry, I read the Quantica piece this week, which I thought was an excellent write-up, where they are looking at the diversification properties of trend following. And I know, we're particularly focused on 100% trend following, but there is no doubt that, the inclusion of diversified systematic trend following into almost any portfolio, particularly those dominated in equities and bonds, certainly does improve the overall performance. And I was playing around with a few scenarios using SG Trend Index as my allocation device into numerous different portfolios, and in every case that I looked at, it improved the performance of the overall portfolio. And as a diversifier, it truly has. It's historically also been a better sort of diversification device, in my opinion, than the bond allocations from a classic 60-40 portfolio. So this piece by Quantica was basically endorsing that viewpoint and gave a number of very good sort of documented evidentiary reasons for why trend following does act as a very good diversifier.
Well, could you imagine if that wasn't true? Wow. I mean, that would rock our world, that trend following, long, short, currencies, commodities, stocks, bonds would not beat bond, buy, and hold. That would be, or or stock and bond buy and hold. That would be shocking. But I don't like to look at it in those terms about how adding diversified CTA trend following to a portfolio. I would be very interested in how does trend following those equities along with the other markets, how does that compare to just long equities or 60/40? So I haven't done that, especially it's going to, my theory, I think, is that it would get better with more, with 200 or 300 markets and with a substantial 25% minimum allocation to equities. I think that over the total test period of 30 or 40 years, that I'm going to guess that that's going to be better than the stocks in any perspective, whether it's risk adjusted or not risk adjusted. It's going to do a lot better. And then it begs the question, though, of the different results that one would get in a back test based upon how you choose the individual equities. They'll be a material part of the portfolio, trading them individually, long and short, and then how, depending upon which ones I choose, it may tremendously overperform. Depending upon which ones Rob chooses, it's not absolutely, it's not going to overperform, right? Or someone else. So it's I think that that's my new mantra here recently has been sell some of your buy and hold equities. Don't allocate 5 or 10% to trend following. Sell a substantial amount of your long holdings in stocks. Allocate that to Jerry, and I will put those stocks, better stocks, in your portfolio, and I'll trend follow those stocks. So if trend following works, when you add 5 or 10% allocation to your portfolio, then how about let's see what happens when you let me trend follow some of those equities that you've just been buying and holding. That's, I think, the big question for institutions and allocators.
And I want to say that I remember you said once, Jerry, that maybe not once, that fundamental crowd, they look at the assets on the buy and hold perspective. And if we are talking about especially about currencies, about commodities, it's a very bad idea, and I fully agree with this. It's not a very good idea in general to be a buy and hold guy, I think, and a lot of reasons for that, for me personally. But if we are talking about currencies and commodities, it's also even strange, I think, and people really, people, I noticed that people ask the question, what asset class in commodities I should buy to be more wealthy? And it's a common question, by the way.
Hi everyone. Glad to be here. Not as Oleg, but surely really glad. On that question, Jerry, I think the big hurdle is how can we deal with career risk from allocators. I think the real problem is that, okay, it's if you look at the numbers, it's fairly easy to agree that trend following works on the longer term. It's definitely the strategy that protects you from a big drawdown, that accumulate the larger wealth. There is no much question of that, especially on those experienced managers. No question about that. The problem is for an allocator, it is costly if he underperforms on a single year, underperforms relative to his peers. So the argument is should be, how can we convince allocators that career risk is not there? I think that's the real challenge. What you say?
Yeah, maybe. I think with trend followers in the portfolio, a small allocation. So I think it's the drawdown part maybe that they don't like if it's a classic trend following. And then once again, you could do that same allocation of 5 or 10% to someone who's trend following stocks or has trend following stocks as a material part of their trend following program, and take it from there. So I'm not so sure that these allocators feel some sort of pressure to launch out into new things that are that no one else is doing. They probably have a department, some of them, to find those things specifically. Go find me something that we don't already have. So I'm not so sure. I think the biggest hurdle is that CTAs themselves don't advocate. The CTAs they allocate to, the largest ones, they don't even trade single stocks in their managed futures program. I was listening this week, though, to a podcast, and I don't know if you listen to this podcast. It's Flirting with Models, and the gentleman was from Campbell. And he described his firm, and I have probably overstated and misstated some of the ideas of what CTAs do, acting as if I know what everybody does, which I don't, of course. So, but he described, kind of different products that they have. And Campbell is probably the oldest and done, the oldest trend followers out there. I mean, they started their trend following in the 70s probably. So, and they have both evolved a bit, but Campbell's really evolved into multiple offerings for clients. And one is traditional managed futures, which has no single stocks. It's not what managed futures does. It's what Jerry says, but it's not what we all do, what we've come to acknowledge. And it's not going to help you to fit into the managed futures box that allocators have. And then all the way up to, he said, we trade in another program, we trade, futures and currencies and commodities and 5,000 stocks. So he actually said more than once, 5,000 stocks. So these people, these CTAs, maybe they are trading stocks and they are, I don't know if they trend follow them. They probably won't admit to the degree that they trend follow or take small losses and let profits run. But they do offer it. It just is not going to be part of managed futures because everyone has an accepted definition of that, and expanding it like I want to into trend following lots of different markets, ETFs and individual stocks is just not quite accepted yet. It's not what they've all agreed is the definition of what CTAs ought to be doing, unless you define another program and offer that as something entirely different. I just want to take all my best ideas and the optimal way of doing things in all the different markets and put it into this single program.
It's very interesting, really very interesting information. I just wanted to say that I often see people don't like not only the drawdowns, the big drawdowns, they don't like the idea of drawdown. They don't like the idea of waiting something. Once I remember, maybe 6 years ago, I was speaking, by the way, not far from the place I'm now. I was in the same Black Sea Coast resorts, and one guy from Moscow said to me, "I will give you maybe $1 million United States dollar, but at least it will be $300,000. But I need 100% a year annual return. I need maximum drawdown 30%, and I need a drawdown will be not more than a month, because I gave money to one trader and he has a 3-month drawdown." So there's a whole idea of these things, I think, and maybe it's okay if you work on a construction building, and it's okay to have everyday profit from it, because somebody, if you're a worker, and somebody will pay you a salary. But in business, it doesn't work such way, in business in general. So here is my point.
Yeah, I'm not so sure people dislike drawdowns that much, or at least they can communicate how they dislike drawdowns. Because there are so many people so many investors on 60/40 or on risk parity, and that both strategies have deep drawdowns. Main issue is being in a drawdown alone.
Yeah, I'm sorry. Yes, I think it's like Neil said. Often it's okay to be conventional, wrong, so something like that. Because when we have here, people have an explaining that something bad happened, and by the way, all the mainstream media programs people in such way of mindset in a lot of fields that now we have a problem in the economic machine stop working in a proper way. It's okay. So we are all in a drawdown. We are all. It's an economic problem. And people think that they understand what is going on in the economy, and they think that's okay. It's a part of a process. It's okay. But for me, for me personally, I don't understand these processes. I don't understand this in a deep way. Of course, I can watch video about this, read books about it, and so on and so forth. But I don't even want to do this. So I don't need to do this. And such concept as trend following, people think that a drawdown here is a losing money game or something like that, and if you're in profit, it's a profitable game. So this type of mindset, and as I have said before today, that if we are talking about business in general, the same laws I see here, the same laws that business laws are more similar to trend followers, rules and laws, not macro guys. I think so.
Hello, everyone. Hey, Jerry. Hey, Richard. Hey, Oleg. Um, so this week, guys, so this was a good week for a short-term trend follower. I need to admit, it's just prices trended, the way I wanted to see on my end. And in terms of these drawdowns, you know, we have different tools to be able to address the issues of those drawdowns. One of them is, of course, what we've been discussing around the diversity. So we can add more markets into it, and eventually those drawdowns are going to come a little bit. So you can try to trend follow, let's say, Russell 2000 or Russell 3000. Or you might say, okay, I'm going to trend, actually, I'm going to create something else using the world MSCI index, or some other equity index from FT or Dow Jones or S&P. So you can use these ideas to be able to further diversify. It's just going to help on those drawdowns. And the second thing is, of course, the time frame diversification. So we've recently discussed about aspect capital, and there's the shortest term that they are trading is less than 7 days. So what they are doing is not too far away from what I am doing, and I'm implementing that sort of an idea with a classic trend following view. So one entry, one exit, and the one stop, and it's and I can see that when I look into my drawdowns, and when in this group and we complain about the drawdowns, for instance, drawdowns is not my number one issue on my own trading. So I do have some other for me, risk management has some other priorities rather than looking into drawdowns, because when you trade short term, the drawdowns are hardly going anywhere else more than 20%, and more often than not my average drawdowns are 10 to 12%. So really there is not much worry on that end, but it is there are other things that I need to be following up, like executing thousands of trades. So I'm executing thousands of trades. So I need to ensure that the operations are going as expected, and me not not in front of the screen all the time. So I'm at the moment in central London, for instance, and so I'm not following it up, and so things needs to work so that I can have a work and life balance. So we need to use the idea of speed, basically. So we need to diversify among markets, and we need to diversify among speeds. So once we do that, once we use those two tools, I don't think there's much of a drawdown issue, really. That's the point that I'm trying to come at. Thank you.
That's a great point, Trading Mentor. And the way I'd sort of state that is that if, for instance, you're applying a single trend following model across 100 markets, you'll find that correlations actually do become a fairly big issue. This is correlations amongst markets. However, when you apply an ensemble of trend following models, say 4, 5, 6 or so, to across that 100 market portfolio, the impact of correlations is significantly reduced. And the reason for that is that there is an inherent correlation relationship between markets themselves, but you can break that level of market correlation through system diversification, which is what I view as a structural breakdown of correlation as opposed to a market correlation relationship, if that makes sense. So if you are concerned that you do face very large drawdowns, have a look at the opportunities arising from trading an ensemble of trend following models to those markets as opposed to maybe one or just a few trend following models.
Yeah, and I tweeted a paper this week about some people doing a study on how correlations can give you a false impression. The lack of correlations can give you a false sense of comfort. But you should look at sort of is everything in an uptrend, or are all your stocks in an uptrend or downtrend, and what are the positions? And I think if you're having trouble with drawdowns, it could be a situation where you're not diversified enough. You think you're more diversified than you are. And for trend following, you could talk about your stocks and talk about how many you have on and how and give the impression that maybe it's more risky than it is, because like right now, I'd say at least half of the stocks I follow in my fixed portfolio are short. So that really matters. And it's not the case with currencies where I'm short everything, and interest rates short everything, mostly long commodities. So stocks are the best and only place now to find any sort of long short diversification. So if stocks crashed or rallied, I'd be happy. I mean, I'd be break even probably, because I'm 50-50, and it's strictly just based on the trends, not anything else.
Yes, I think that, of course, as Jerry said, that all can go to one, and of course I have my own opinion that commodities are better diversified sector, but in fact, maybe I don't really know that. In fact, I don't really know that, but at least I have seen that how commodities also, at least that commodities that I trade, how they also go to the same direction, most of commodities. The same sell-offs, the same trends. Okay, but the whole idea of diversification, it maybe...
We've lost you, Oleg.
Oh, I think it was Trading Mentor who posted something this week again that I have seen in the past few weeks. It's something about how to improve shorts. Unlimited profit might have been one of the things he mentioned. So I was hoping that maybe you can explain this to me, and I think it has something to do with continuing to sell more as the ATR gets smaller on the shorts. Is that right, Trading Mentor?
Yes. Hey, Jerry. So basically, so what happens is, so if we think about 2014, where the oil prices have come down from $120 to $30, it was a one big ride for long-term trend followers. And it was a very, very, very good trade. But what has happened is, so you entered into that short crude oil trade in 2014, when the price of the crude oil per barrel was around $120. But of course you didn't, so that quantity calculation haven't changed when long-term trend followers were riding that particular trend in 2014. So the price has come down from $120 to $90 to $60. You're still riding that for more than a year, but you were unable to load more quantity into it, even though the ATR has gone down significantly. So what I'm doing on my end is, because I'm a short-term trend trader, I'm entering and exiting many times to the same trend. And each time I enter and exit, of course, I enter using the ATR available at that point in time. So the quantity calculations are being updated, and that's why I do have unlimited upside on short-term trends too. If that makes sense. Thank you.
Yeah, okay, I get it. It's definitely something particular to short term, and I'm fine with all of that. I think that I forgot for a second that you were speaking for the short term traders, but I think that longer term trend followers who continue to vol adjust can do the same thing. And you're applying, let's say, your one entry, one exit stop loss sizing on ATR, um, and it's very short term. Okay, so that's far better and more robust and different from a long-term trend follower with a very wide, the 150-day high would be their exit in that crude trade, or 100-day high, and they continue to vol adjust. So your trades don't fall out of the uh, realm of the core system, where the long-term trend follower who continues to vol adjust on the way down, the way you described it, he would have an overlay and be doing trades outside of his core system, which I would object to based on sample size. That's all. However, when I first heard about this idea a few weeks ago, that term unlimited downside, I mean, it's only unlimited. Well, it's only increased if you do it the way you do it. But I immediately went to that crude of 2014 chart because it kind of, I couldn't, honestly, I could not even remember a good short other than that crude trade. And I, and of course, I wasn't really thinking maybe about currencies. It could have been a currency trade or something. I immediately went to, okay, where's this wonderful short trade? And it was only crude. And I looked at that. I'll have to go back and look again, but I looked at it and I did not see all the way down in that a lot of decrease in ATR. In fact, it would increase, decrease, and so I'll have to go back and look at that, and maybe we calculate ATR differently, and maybe mine is longer term than yours, or something. But I do strenuously object, not to what you said, but I think others have said. It's just ipso facto. Shorts, the ATR decreases, and that's just not true. I mean, maybe sometimes, but I think they suffer from the same thing that longs suffer from, and that is you get a good period of consolidation. It breaks down, you go short, and as the market gets weaker and weaker, and you're making more and more money, the volatility goes up. I think maybe it's less so in shorts. It's almost a given in longs. But yeah, I'll have to go look at that short crude trade again. I just have not noticed. I did not notice my first look into it that the vol was ever decreasing.
But I guess, Jerry, it's more about the principle. There might be a trade where the vol might be decreasing because the vol might be much lower if the price is $30 as opposed to $120. And I guess the point being is, so when you're riding those trends on the long term, that model, there is so would you call it a model deficiency of long-term trend following models where you do not actually have this unlimited upside because you're carrying the same shorts for a year or two, and just in case the volatility goes down, of course you're not actually capturing that within your quantity calculations, for instance. But on the other hand, if you are a little shorter term trader, a medium term trader, or a shorter term trader, where you're entering every couple of weeks or months, or someone else like me much more sooner than that, of course we just take the advantage of the ATR at that given point in time, and it is not always shorter. It might be higher at times and it might be lower at times, but the potential will be there. Thank you.
Yeah, I definitely see it as a kind of an advantage or disadvantage in some situations that shorter term has. Obviously, I don't think short term can improve upon a big uptrend of natural gas, U.S. natural gas, because we put the position on at such a small ATR, and it's done nothing but expand and go crazy, and have violent up moves and down moves, only to go back and make new highs. So now, risk adjusted, you can definitely improve upon a long-term trend following performance. But on this podcast, on this spaces, we don't care about risk adjusted. We disagree what risk adjusted even means, at least the risk part. So yeah, I think it's a different ball game with short term versus long term. I lost my train of thought. Sorry.
Oh, it's all right, but it
Perhaps
is
go on,
so
Mander.
yeah. But overall, when we're discussing about diversity, and now, I think the point being is, if I'm able to do it, a new trader, almost anyone else can do it. So there's not much about complexity about trading the short-term systems, as opposed to like 10 years ago. The brokerage costs come down, the technology, the coding is not like an esoteric subject like maybe 20 years ago or 10 years ago. So it's you can go to the Udemy, just give $25 and learn how to code and etc. So I think when we talk about this diversity of including equity markets into it, and I think that idea of diversity, when we incorporate this time horizon, different, something else that your nightmares in, you don't have more than 30% drawdowns anyhow. It doesn't exist in my model, for instance. And when you capture all this diversity, then it will be much more.
You're breaking up quite a bit.
Sorry, sorry, maybe my connection. But the point being is, it will be easier to communicate what we do to the people who try to box me into the 5 to 10%, perhaps. Thank you.
Yeah, I was going to say that take, for example, what's happening with the energy prices in Europe. In a couple of days, the price has decreased 500 points. That's a decrease that's only available because the price is in a such level that allows the price to go so much down. And on the other hand, the price can go down 50% at any time. So perhaps we can do a trick that adjusts our positions so that it's not only ATR based. It's not only that if prices go down a number of ATRs that will represent the same PNL, but if prices go down a percentage of ATRs, then it represents the same PNL. I don't know much about execution. Perhaps that would be costly because you would have to trade a lot to adjust these positions, especially when prices go exponential, such as energy prices. But perhaps there is something there that can make shorts more profitable or as profitable as longs. It's similar to that discussion we were having months ago about the denominating all the other assets in currencies different than the dollars. It's kind of similar that you would have to adjust the positions as each leg of that pair goes one way or another.
Oh, what I wanted to say, what I forgot earlier was that the self-imposed limitation that I have on all of my trading is to be very consistent and follow those entry, exit, stop loss rules and never violate those rules or not have any more extra rules for special situations. Yeah, it probably doesn't make sense now. But and another thing too that always pops up, when we have discussions, and that is I have to keep reminding myself that I have a fixed trade level that doesn't change very often. That's based upon capital, closed trade equity, and not current AUM. So part of the ability to maybe possibly increase the profit on shorts is not just the ATR goes lower, but if trading mentor is using his current AUM as the new trade level, as he's making more and more money on the short, then he's putting on a bigger position, not just based upon reduced ATR, but based upon increased capital in his account. So I keep forgetting, these nuances. And I think that one thing I've learned in talking about this stuff, because the more I've been on Clubhouse and Spaces, the more I've talked about it and the more I've thought about it when I'm out walking my dogs, thinking about what people have said, what I've said, and how to make it clearer. And I'm like, oh, wait a second. This whole trade level thing where we don't use percentages, we only use ATR, and we don't move our trade level up and down, and its mine stays as constant as it can for as long as it can. That's my preference, and it has nothing to do with current AUM. I keep forgetting that how important that is, and I forgot that it is so important, especially when people have different experiences. You're experiencing something totally different because you're using current AUM for every trade, much different than me. And I can see how some people are like, I must have this risk budget overlay, this risk overlay, this drawdown overlay, this heat map, heat. I have too much heat on. And I think, oh, yeah, because you're doing the trade level thing wrong, in my opinion. So, yeah, you're doing that wrong. So you have to do something else later. I'm doing it right. I'm sitting back and not having to stress out about some of these drawdowns. Yeah, you can never forget that thing about how important trade level it is.
And trade levels, for on my end, on my trading, because everything else is run by algorithms. So yes, so I'm using the current equity to be able to size my positions. But because while trading short term, as I mentioned, in my system, average drawdowns are 10 to 12% anyhow. So I do not have any concerns around using the closed equity, which might be an alternative option to use versus current equity. And I can backtest both of them. It is possible to backtest both of them or another version of the equity. But I think the point that I'm trying to make is it needs to be automated because I don't interfere with the trading process. I don't touch the algorithms so that I can live a life. And the second of all is the thinking is different. On the long term, you're trying to minimize those possibly more than 30% drawdowns, whereas that is not a limitation on shorter term speeds. Thank you.
Yes, exactly. The shorter term you trade, the less important that to use closed trade equity, because your closed trade equity is probably 90 to 99% of your total equity, whereas a long-term trend follower who's building up these huge open trade profits because they're doing one trade per year, and I haven't touched my crude position in a long time. You've been in and out of crude maybe 50 times or 10 times. It's my closed trade equity could be 50% of my total equity. So yeah, it's this is a problem that gets created by long-term trading. And when I traded back in the 80s, it was not long-term. So this issue really wasn't that important. But then as I gravitated towards realizing that the markets were very choppy, and in order to stay in the trends, you needed to move that trailing stop out from 20 days to 120 days, let's say, then this problem crops up. And yeah, but it's not something for a short-term person to really worry about.
G'day, Mike. How are you going?
All good here. How's it going?
Not bad. Look, I've been very impressed lately over the last couple of weeks with those short 2-sentence tweets you sort of tend to sort of push out onto the airwaves. They're great tweets.
Yeah, thanks. I don't get to do that very often. They're usually too long.
Yeah, well, I wanted to just say I was trying to provoke Mike this week or last week, and Mike has lots of interesting things and he's to say, and he has an interesting way of looking at the markets. And I think it's much more going on in Mike's analysis than in mine. And yet I think Mike wants to be a trend follower, and he definitely uses trend following principles. And so I'm sitting there with these positions on for a year or so, and just watching them go up and down. Like I said, short indices at those breakouts indices and stock ETFs, and they rallied, and now they're going back down. And Mike is tweeting, well, if this happens, then this means that the market is going to go up more. But if it breaks this line, a week later, if it breaks this line, I think a lot of the CTAs are going to come in and sell. And so I'm not sure exactly. Like, I could tweet those things too, but I would just have to say, but this doesn't mean I'm going to do anything, you know. And I think that Mike is more active than I am. And so that's when I tweeted this idea that I firmly believe this, of course, from a trend following point of view, systematic long-term trend following point of view, entry, exit, stop loss. I tweeted something like, in between, after you get in the market and then before you exit, unless you've exited, there's nothing going on in the market that is going to add value to your system. So you can analyze what's going on with other traders, or what other people are saying, or the patterns, the reversals. The news did this and the market had a certain price action, but this means nothing. And until your exit gets hit, that's when you get a piece of information. And that information is just, you should get out. And it's basically the whole trend following philosophy is, if you did those trades, that entry, exit, stop loss trades of your system, you would make money over a long period of time. You're going to take money out of the market. Well, historically on your back test, that's what it has done. And so this is all you're claiming, that I think this is, I'm going to make money if I do this. This particular trade, no. Are others going to be proved correctly by looking at patterns and information that's embedded? The market didn't behave well. The market reacted wrong. This is going to make me want to do something. Yeah, they're going to outdo you sometimes, and they could outdo you on this particular trade. But I think from a long-term or systematic trader point of view, and in fact, even when your exit in your system one exit gets hit, system two, you're still in the trade. So you absolutely don't want to corrupt your system two parameters and rules based upon that you got out of system one. So I think the system trading, there is nothing going on that we can offer to others as it relates to what's going on, what's happening, what does this mean in the markets? What do you think, Mike?
Yeah, I agree with that, Jerry. What I use Twitter for, I do usually one of two things when I'm sitting at my desk during the day. I either play poker online, which I haven't done in a long time, or I sit there and play with Twitter. And so for Twitter for me is just completely just sharing, knowledge or thoughts, observations. And I like to show charts because I like to look at charts, and I've always liked to look at charts. I'm kind of like I like beer. I liked beer. I still like beer, and I like charts, so I look at charts a lot. And so when I'm sitting there looking at charts, and I'm usually probably got some other intention from being for being in my office at my desk, I just tweet out some charts that I may think are interesting, and then the CTA stuff is number one is that obviously I've got multiple trend following systems that are running whether I put money in them or not. These systems are still running, and those systems inform my decisions in different ways. You know, and and whether or not, even if I'm not trading them, they still tell me things. They give me information. So all these different systems inform me of what's really going on in the markets. And but my Twitter, nobody could really tell what I'm trading via my Twitter because, for one, legally I can't do that because my firm is a registered investment advisor, and if we mention a stock or an ETF or whatever that we're buying or selling, then you're technically supposed to provide a document that shows every trade you've done over the last 12 months or something. So it's just some.
All right, let me interrupt you there because you're saying some good stuff that I needed to comment on. And that is, what I guess I'm saying is my systems are not informing me on anything. And so I think that, and they're not even relevant if I'm not following them. So this is the difference, between you and me, is that I'm not being informed. My systems are not informing me about what's going on in the markets at all. That I can do some sort of evaluation of all of this great information. Maybe some of it or most of it is coming from this information that my systems are telling me, and then you'll make this decision. I'm only just following these, and I don't think that these systems are able to say very much. There's no information in these systems. The minute I get out, it goes back to new highs. Why is this happening? This system is not very good at informing me. And so, yeah, I think that's the point I was trying to make. You're making it for me, and that is it's a whole different world from a cloistered system trader guy who is only paying attention to these systems. And I just think it's helpful to recognize for people who are doing that, you're not missing anything. There's nothing there for you. Now, for people like Mike, who accumulates all this information from different sources and from systems that tells him what's going on. This is your world. This is not, I feel bad for people who think, golly, why did I get out and it goes right back down? I got to get back in. Yes, get back in, because nothing that you do systematically is telling you anything other than if you did this for the rest of your life, you will probably take money out of the markets. Of course, depending upon I would say your back test. How robust is your back test? Sorry, Mike. Go ahead.
I think no. There's two different things. I've got systems. The systems that I run that are automated, and somebody else is actually pulling the trigger as far as entering the trades. So I don't even the systems that are completely automated. I don't even deal with it. And in fact, if you this comes up a lot when I'm talking to younger people. If you are if you feel like you're a really good technician, a technical analyst with trends, you're probably not going to execute a truly systematic. I won't call it automated because everybody thinks they're systematic if they follow rules, but you really wouldn't want a technician to execute your trades probably on a completely automated trend following trading system. And the reason I say that is because they're going to look at it, they're going to see the signal, see that it looks right, get a good feeling about it, pull the trigger. It's going to be that kind of a process, which is not what you necessarily want when you're executing a trade based on a system. So most of my systems, for example, would give me a trade signal at the end of the day, just like yours do. And then the next morning, you get up and you enter the trade for, whatever it generated, assuming that you didn't do it intraday. Some people do, but yeah, to me, there's a big, there's the systematic automated, and then there is, discretionary systematic, and those are two different things. What I talk about on Twitter is not. I mean, you if you notice, what people like to talk about is either economics. I mean, like right now, there's another space going on. I noticed whenever I had to drop off earlier, and there's like 5, 6, 7, 800 people on this one space talking about this silly jobs report that's out today. Now, this jobs report, is a big deal, but us sitting around talking about it doesn't change anything, doesn't get anywhere. The fact of the matter is the Dow, and the S&P is applied, it's going to open up because of the job report, blah, blah, blah. However, it may close down. It may do something different today. It may do something different on Monday. What's been happening lately is you get an economic report or a Fed speak. That day it goes up, and that's probably individuals getting excited over it. And then the next day it gets hammered, and reverses whatever it did the prior day, because then institutions are waking up and making their decisions. But my point is, I've got completely automated systems that I can run completely automated, and I don't even have to be involved in that. These systems generate a signal. It gets sent to somebody. They plug it in with Goldman Sachs. Trade get executed. Boom. And then I have my main portfolio, though, is multiple systems combined, where I'm ultimately making the decision. I can fully, on a fully automated basis, it doesn't quite get to where I want it to be. And so I add in some other things. But I mean, ultimately, like I say before, I'm trend following probably, 90, 95% of the time when the trends are there. But it also, for me too, by the way, we're running separately managed accounts with, custody to Goldman Sachs. So, these are individual high net worth investors, and, we're managing portfolios based on their risk and reward expectations. And, so that's another thing, is that, when it comes to the fund, if you're managing a limited partnership, private investment fund, then you're a fiduciary to the fund itself, not to the people that are investing in it. If you're investing or trading separately managed accounts as a registered investment advisor, then you're fiduciary to the client. Okay. Not the account, and there is no fund. So, those are other things that what I'm able to do is, somebody contacts me and says they've got, a couple $1,000,000, and here's their drawdown. They don't want to have a drawdown more than X. They want to try to have an expected return of X. What I'm able to do is take these different systems that I've been running for all these years, 20 years now, and combine those systems depending on what that person's looking for. I can combine those systems into a portfolio that fits them. And because most people ultimately want the same thing, amazingly. Most people, so for example, I've got a family that's been a client of mine for 2 decades. And it was, I had the grandma, the daughter, and the daughter's kids who are now in their, like 30 years old. They're now in their 30s. Three generations over the last 2 decades. Amazingly, a 30-year-old daughter has the same risk reward expectations as mama does, even though she's 70 and retired. And, and it's because neither one of them want to lose too much money, say 20%. So if they lost 20% of their equity value, I want to know when they're going to tap out. When do you think you would panic based on the numbers? And most people say around 20%. Most people can tolerate around 20%. And I'm talking about all their money, their entire portfolio, the total portfolio.
Yeah, let me cut you off there. I want to, it's just a whole different world of following a system and getting people to buy into it and then creating what you have. So it's just interesting. And you've been very successful at it. But I think it's very difficult for people to do that, to be as successful as you are versus what I do. It's very easy to be successful.
Well, if you think about it, it's Paul Tudor Jones. I actually just realized this literally this year. This year I've done some interviews, which I haven't done in probably a decade. I mean, I think the last podcast kind of thing I'd done was with Niels, seemed like it was probably 8, 7, 8, 10 years ago. And then before that was Covell, with his. Recently, I've done some other ones, and one of the big things they get into is, how did you become you, kind of, the details of your past, which you start, which I don't really think about the past that much, but I started reflecting. And as I was talking to this one guy, who spends a lot of time, sort of like Jack Schwager did, looking at historical traders and stuff. He mentioned that it sounds like sort of like Paul Tudor Jones, or sort of like, because actually that question he asked me was, who do you think, or who do you aspire to, or who's your trading hero, kind of thing. And I really couldn't come up with anybody in particular. There's maybe some, there's a lot of people that I've, studied, obviously, but what I come to realize after talking with him is he also mentions, what's the, not Paul Tudor Jones, but the other, Stan Druckenmiller. Yeah. So here's funny, because the topic was, using, fundamental versus trend, looking at the trend versus looking at fundamentals. And this was just a private conversation I was having with these people. And they said, well, it sounds like, Stanley Druckenmiller or Paul Tudor Jones, where they publicly, you don't know a whole lot about what they actually did, for decades, but what you do know is Paul Tudor Jones said that he don't like to deal with anything under the 200-day moving average. So that's a trend follower. The 200-day moving average. So if you're using a 200-day moving average applied to anything else, then you're ultimately adding a trend following, parameter over whatever else it is that makes you decide to buy or sell something. And then Druckenmiller was the same, kind of similar too, in that he did, I think various ways of looking at trends that's publicly stated. And so he may have had analysts come up with, hey, this stock here looks great, but then he would actually look at the charts to determine, what and when to buy or sell, as opposed to, so that's kind of where, if what I always go back to say is that if we could completely automate everything we do, which I can, but the reality is, show me who has been doing that for 30, 40 years, 20, 30, 10, 20, 30, 40 years. In other words, who developed a system? And the reason I say this, because I developed these systems right at about 20 years ago, and it was a lot of them, a couple dozen systems, and I've watched them all this time. Now, whether or not Whether or not I want to put money into them, is up to me. But the systems themselves are all separate and they're running. Okay. And it's like none of those systems I would have trusted enough to be the one sitting at the table having to explain. I ultimately want to have that control. So there, for me, there is a human element in that I'm the one that's ultimately pulling the trigger. So it's man plus machine, as I've said for many years. I've got the machine.
Yeah, I'm just saying that we're doing it different, and we're trying to use a little bit of man in the beginning with our back test, and then step away and let the machine carry forward. Anyways, does anybody want to make a comment
Well,
on
let me
what
say
Mike's
one
been
more thing to
saying,
that.
Richard, or
Let me say one more thing to that, Jerry. The thing is, if there was no man, what I'm saying is nobody back tested a system 30 years ago, and they're still doing that exact same thing today. What they're doing is their discretion and the human element is that they are looking today at trading stocks and ETFs. You see, they're looking today at, just like somebody who's trading stocks and ETFs would like to be trading futures this year and be short, long rates, short stocks, whatever, but nobody has just tested a system, because that's what I think what's happened in the industry since 2008 in particular, because most people crashed. Trend following made money, or at least if I'm more long or flat than I am long or short. Like if I sell my stocks, I don't stop in reverse. I don't stop and I don't go from long to short those stocks. I go long to flat and then see what else is maybe trending in the direction. But I think I don't know of anybody that back tested the system like in 1970 or 1980 or 1990 or 2000, and they're still running that exact same model today. Because the truth of the matter is, there's hardly any of them that anybody would have stuck with. But what I think's happened though, Jerry, is that you've got all these people now who call themselves, quants, which we all are. I mean, this whole group here is definitely quants, because we're not talking about employment reports. We're talking about trends. But I think that what's happened is you got this whole generation of people post 2008 who learned how to back test, and there's all kinds of cheap software out there to back test and websites that you can back test. They think they can go in there and curb fit the data to their liking, and then they'll offer that as a portfolio. And then guess what happens? I don't have to say, what happens. It doesn't end up doing what they thought it was going to do, because they didn't back test, all kinds of reasons why that may happen. They didn't, small sample size, whatever it may be. So my point is that we continually have to part of a big thing that I do is continually be thinking about what could I be doing better, how could I, and that's not to say that I don't accept my trading as I'm doing it, because I'm pretty happy with what I'm doing, but it's just that I'm constantly thinking about more than anything for me is reverse engineering. I'm looking for what can go wrong, because what can go right is good. I don't have to worry about that. Let that run. But the things about what can go wrong, what may be wrong with this. But I think that, the human element comes in, that I think everybody should always be looking at new markets that are available to see, should I add these? Just like you and I talked years ago about the VIX, for example. Trading or just
All right, let me get some other people in here, and you're preaching to the choir on that, because I been adding stuff, ETFs, short ETFs. I've been obviously short a lot of the interest rate ETFs and stock ETFs as well. So I'm interested in what's going on with Moritz. Are you able to talk, Moritz? How's it going?
Hey, I'd like to, but I'm still at the beach. I'm sorry about that. It was a fat finger. I hit request accidentally. I'm sorry. It's too noisy.
Nice to be some people, Moritz.
Yeah, I know.
Well, another thing that caught my eye this week was a tweet from Neil, where he brought up this idea of, this is a good thing to discuss. I think it's very interesting, and that is, he brought up this idea of trend following the trend followers, and I think he read a book or a paper where that was not something you should do, trend follow the trend followers. And then he proceeded to ask the question, since the S&P index is a trend following, I forgot how he worded it, trend following like, or has trend following components in it. Should we be okay just buying the S&P index anytime, just like we would be okay, it's proven to buy CTAs who trend follow at any time. You can't really time them. They're timing the markets, so you don't want to time them. They have a positive expectation. It's always a good time to invest in the CTA program. You can't time it, but is that the same thing as we should just buy the S&P index since it has a bit of trend following in it as well? Do you want to explain that better, Neil? Or is anybody, you want to comment on that, Rich?
Yeah, look, I think we've got to bring Neil up as a speaker, or he needs to come on as a speaker. But I think he was referring to that Kaminsky-Graceman book towards the end of the chapters. And look, the more I'm getting to understand trend following, I tend to follow your line, Jerry. I tend to think the less information you can actually derive from it. In other words, our rules-based systems and our processes that we develop are the only things that matter. There is no additional information, particularly in that tail region of the distribution, that we can draw on to infer any extra edge. Of course, there are people that would entertain the prospect of blending convergent models with divergent models. But in our case, where we are purely focused on divergence and the tail region, I personally think that the more I'm comfortable with the proposition that there is no information available subsequent to taking that entry that can lead us to any extra edge until we exit that trade. So, our systems are the constraints that we apply in these tail regions. And even though the trend might not have ended and our systems get closed out, other systems are still holding, really that's as best as we can get. There is no information there that's going to help us out. So in relation to trend followers, look, I used to think that there might be an opportunity in investing in trend followers when they're in drawdowns. But the more I'm thinking about this information deficient region of the tails, I'm thinking that is a furphy. And I'm thinking that really we can't time our entry into at least classic trend following models, or actually I shouldn't use that word classic trend following anymore. I should use the word just trend following. I think you probably can time CTAs, these mismanaged CTAs that you refer to, Jerry, but I certainly don't think we can time trend following models.
No, nor do I. And I wanted just to comment on his comments about the S&P, and I think that the S&P is quite a bit different. I mean, I guess it does have some sort of trend characteristics, but to some degree, it's back to this question: Are we looking at trend characteristics? Are we looking at trend following to inform our opinion? Are we looking at trends to be one of many things to help us make a good decision? Or are we using a system that, one thing that Mike said, it was kind of funny, is that because I've lived this for many, many years, and that is that I wasn't happy with what I was getting or something like that. Yeah, you're damn right. I'm never happy with what these systems are doing for me. And I'm kind of not able to go in and do something about it. write a rule so I could pretend that I'm still being systematic trend following, or just exercise discretion or use it as an input. No, I've sold out to these systems, and I'm only going to do what they do, and I'm going to be frequently disappointed and have performance that I'm not going to be happy with. And so I think this S&P is sort of has some trend components in it, but it's severely negative skewed. And I was trading Tesla, trend following Tesla when it first broke out a few years ago, and so then what happens a year and a half later? The S&P adds it. Well, what was this? Okay, what was the rule for this entry? And then it's not a good one, because the time to have for this S&P trend following index to have bought the S&P or added the Tesla was when I added it. So I don't like this system that they've come up with. If it is, it may have some trend following components to it and maybe look a little bit like trend following, but an 8% return and a 50 plus drawdown and this negative skew, it needs to, and it never gets out. It just continues to reduce the weighting of these stocks as they go down in value. But then what happens if they all go down in value? Yeah, it's a basket case. It's not much trend following going on there. My recommendation on the S&P is to trade some of the stocks in the S&P, but I wouldn't even trade the S&P index as a trend with my trend following, because you could do so much better by picking your own stocks. Or if you don't want to do that, just trade some of the stocks that are in there, use the ATR at entry, et cetera, et cetera.
By the way, I want to say that S&P is very high, all stocks, not all, of course, but I think that most stocks, famous stocks of S&P, is very high correlated to each other. It's much more correlated than individual stocks to each other, and I'm sure it is so.
Hey, Jerry, let me comment on, can you hear me? It got quiet there for a minute.
Yes, I can hear you.
Okay. Yeah. So what you said about following the system, see, for me, I look at it like I'm the system is me. The system, I just had a call with somebody yesterday, and or actually a Zoom meeting. We were talking about it, and I explained it as the system is doing what I want it to do. It's ones and the zeros, and I'm gonna, I want you to tell me to buy when this happens, tell me to sell when this happens, tell me, calculate how much risk I should take at any time and how much risk I have on at any time. And so the system for me was back 10, 15 years ago when I would get irritated at, having people, looking at charts and doing it the old fashioned way, which I think you guys did it in the turtle program. I think you looked at charts back then because, you didn't have a computer in front of you with trading blocks or whatever. But, for me, I wanted to remove the human element from the process of the research of the signal generation. And because it was algorithmic anyway, it's just simple, mathematical equations. And so I want the system to look at all these markets, and in the morning I go and look at it, and it's going to tell me what I should be buying and what I should be selling. But ultimately the system is doing what I want it to do because it's doing what I told it to do. But what happens is over time, I think what's something that's really important is as we pass through time, there are some things that do change. And, there's new markets. I mean, like now you have Bitcoin and all this stuff, which I've not traded any of that. But there's all kinds of new things that come along that you so I spend a lot of time looking at the universe to which I'm going to trade. So like ETFs, I started trading, as I started trading ETFs 20 years ago, mainly because I didn't want to go through the process of being a CTA and all that. That was just, as very unheard of, is more little known 20 years ago than it is today. But but through ETFs, I was able to trade sectors and countries and commodities. And now, they've broken it down into just about a lot of the things that you can trade with futures, but it's just simply an ETF. And, so I developed systems that do to those markets what I want it to do. And so I'm the king of the systems, not the other way around. Now the systems, if the ones that I run automated, they're going to run and do their thing. But to me, the system is a function of you and what you're trying to achieve from it. And why I call it asymmetry is because I want, more reward than I take in risk. I want to, that was the old MAR ratio, which you don't hear about anymore, but the managed accounts ratio of what's your worst drawdown versus your total return over some time frame. That's asymmetry. Mathematical expectation, that equation is asymmetry. Both forms of it, both the ones, all of that is all about asymmetry. It's about skewing for more reward for the risk that you're taking. So you're taking a certain amount of risk, and we want to generate a greater return, over time, and that's done through the process of trading, hundreds and hundreds of trades, and it's based on expectation. So all of those things are asymmetry, and asymmetry is even part of my options trading. So if I buy a call option for $1, and on average, I make $2, from those call options, and I do it 1,000,000 times at a 50% win rate, then I'm going to make money, and there's positive expectation. So that's how I see it. Is to me, the systems are there to they literally, for me, took the place of recruiting people and having people doing charts, because I did have that, and I found it difficult because people, their kids get sick and they call in, or whatever, they're distracted, going through divorce, whatever it may be, all these things that can distract a person. And so then I don't get then I have to either go do it myself. You know what I mean? So the system, computer programs don't make mistakes. If it's ones and zeros. If it made a mistake, you caused it, not the program. The program is just going to do what you tell it to do. And that's the beauty of it. And that's why I say man plus machine, because I just acknowledge the fact that I am the one creating the machine. I'm the one running the machine. And I'm the one that ultimately takes responsibility for 100% of what the machines do and what I do with it. So I just want to make that point.
All right. Thanks, Mike. You're breaking up a bit. I'm going to sign off early today to go out to the beach and play with my dogs and start the weekend early. So I hope everybody has a good weekend, a good Labor Day, and look forward to seeing everyone next week. Same time, same place, and be well, everyone. Happy trading.
See you, everyone. Bye.